the US Treasury plays a crucial role in global finance, with US Treasury securities serving as a preferred investment for many nations due to their stability and liquidity. Historically, these investments have supported the US dollar's dominance as the world's primary reserve currency. However, recent policy decisions have introduced significant uncertainty into international markets, prompting some countries to reassess their reliance on US financial instruments. In early February 2025, the administration escalated previous trade policies by imposing new tariffs on steel and aluminum imports. These include a 15% duty on imported steel and a 10% duty on aluminum, a move intended to boost American production but one that has sparked concerns over rising costs and potential retaliation from trading partners. Furthermore, the administration has signaled plans to impose blanket tariffs on all imported goods from every country, a dramatic escalation of previous trade policies. This proposed measure, aimed at reducing the U.S. trade deficit, could further strain global trade relations and disrupt supply chains. Such aggressive tariff policies may deter international investment in the U.S. as countries seek alternative markets and diversify their foreign currency reserves. Data reveals a notable decline in U.S. Treasury holdings by several countries. Over the past decade, China's holdings have decreased. Several factors contribute to this reduction. Historically, China's significant trade surplus with the United States resulted in an accumulation of U.S. dollars. To manage the exchange rate and maintain export competitiveness, China invested these dollars in U.S. Treasuries. However, since 2018, as the trade imbalance has declined, the need to buy U.S. Treasuries to manage the exchange rate has naturally diminished. Chinese policymakers are facing increasing calls to reduce the Chinese financial system's exposure to dollar assets. This strategy aims to mitigate risks associated with over-reliance on a single asset class and to enhance returns by exploring alternative investments. The evolving geopolitical landscape, particularly tensions between the U.S. and China, has prompted Beijing to reassess its holdings. Reducing exposure to U.S. debt is viewed as a measure to minimize potential vulnerabilities arising from political frictions. It's important to note that while China's absolute holdings have decreased, the overall market for U.S. debt has expanded. As a result, China's share of total outstanding U.S. Treasuries has diminished over time. Japan's holdings have also decreased. The slight reduction is primarily attributed to Japan's ongoing interventions to stabilize the yen. With the yen experiencing significant depreciation against the U.S. dollar, the Bank of Japan has periodically sold U.S. Treasuries to prop up its currency. Furthermore, Japan's own fiscal policies influence its reserve management strategies. India's holdings have fallen. India's reduction aligns with foreign exchange management strategies. The Reserve Bank of India has actively intervened in currency markets to stabilize the rupee, which has faced depreciation pressures. Additionally, India has been diversifying its foreign exchange reserves by increasing its gold holdings and exploring alternative asset allocations. This move is also part of India's broader strategy to reduce dependence on U.S. dollar-denominated assets while strengthening trade partnerships with emerging economies. Saudi Arabia's holdings have declined. The recent decline likely reflects a combination of lower oil revenues and strategic financial planning. The kingdom has been focusing on economic diversification through its Vision 2030 initiative, which aims to reduce reliance on oil revenues. Additionally, Saudi Arabia has strengthened its financial ties with China and other trading partners, which may influence its allocation of reserves away from U.S. Treasuries. Germany's holdings have reduced. The slight reduction could be attributed to shifts in Germany's reserve management strategy amid inflationary concerns and changing monetary policies. Additionally, Germany has been increasingly investing in green bonds and diversifying its sovereign reserve portfolio. The reduction may also reflect ongoing efforts to strengthen the euro's role as an alternative reserve currency. Norway's holdings have decreased. The slight reduction reflects reallocation efforts towards higher-yielding investments in response to changing global interest rate environments. Additionally, Norway's economic policies focus on balancing risk while maintaining long-term financial stability. The decline in US Treasury holdings by these major foreign holders underscores the evolving landscape of international economic policies and reserve management strategies. Shifting investment preferences are also notable, as sovereign wealth funds, central banks, and institutional investors are exploring alternative assets, including gold, digital currencies, and green investments. Currency and economic policy adjustments are being made by nations with volatile currencies, actively managing their foreign exchange reserves. Despite these reductions, U.S. Treasuries continue to play a critical role in global finance, offering liquidity, security, and a store of value. However, the shifting dynamics underscore the evolving landscape of international economic policies and reserve management strategies. Shifting to alternative financial assets could lead to higher borrowing costs, and many nations are reassessing their reliance on the U.S. dollar. Countries are now diversifying into alternative assets, particularly gold. This shift poses a potential threat to the U.S. financial system, as decreased demand for U.S. Treasury bonds could lead to higher borrowing costs for the U.S. government and a weakening of the dollar's global standing. The Triffin dilemma remains relevant, as America's need to run trade deficits to supply the world with dollars conflicts with long-term confidence in the currency. If foreign investors reduce their holdings of U.S. debt in favor of gold or other stable assets, it could undermine the dollar's reserve currency status. The pre-Bretton Woods era saw the British pound as the primary reserve currency. However, the financial strains of World War I significantly weakened Britain's economic standing. The war effort led to substantial national debt and depletion of gold reserves, undermining confidence in the pound. Concurrently, the United States was emerging as a formidable economic power. The aftermath of World War II further shifted the balance. The Bretton Woods Conference in 1944 established the U.S. dollar as the world's primary reserve currency, backed by the world's largest gold reserves. This agreement solidified the dollar's central role in global finance. The Bretton Woods system established a fixed exchange rate system, with the U.S. dollar pegged to gold and other currencies pegged to the dollar. The International Monetary Fund, IMF, and the International Bank for Reconstruction and Development, IBRD, were created to support this new economic order. Global confidence in the dollar grew. However, by the late 1960s, a rising U.S. economy strained the Bretton Woods system. In 1971, President Nixon suspended the dollar's convertibility into gold, effectively ending the gold standard and leading to a system of floating exchange rates. Following the collapse of the Soviet Union, the 1990s saw globalization accelerate, with the U.S. leading in technological advancements, financial innovation, and capital markets. By the early 2000s, the dollar accounted for nearly 70% of global foreign exchange reserves. The 2008 global financial crisis marked the beginning of a shift away from unchallenged U.S. dollar dominance. While the crisis initially led to a flight to safety, it also exposed vulnerabilities within the U.S. financial system. This prompted central banks worldwide to reconsider the concentration of their reserves in U.S. dollars. China has been proactive in promoting the internationalization of the renminbi. The Asian Infrastructure Investment Bank, AIIB, was launched to provide development funding, offering an alternative to Western-dominated institutions. Through the Belt and Road Initiative, BRI, China has invested in infrastructure projects across multiple continents, many of which are financed in renminbi. China has entered into numerous bilateral currency swap agreements to facilitate trade and investment without relying on the U.S. dollar. In response to U.S. sanctions, Russia has reduced its holdings of U.S. dollars and developed the System for Transfer of Financial Messages, SPFS, as an alternative to the SWIFT network. China has accelerated efforts to internationalize the renminbi and develop alternative payment systems, such as the Cross-Border Interbank Payment System, CIPS, to reduce reliance on the U.S.-dominated SWIFT system. The advent of blockchain technology and the rise of digital currencies are also impacting the global financial landscape. China is at the forefront with its digital yuan, aiming to enhance payment efficiency and bolster the renminbi's international standing. Stablecoins, cryptocurrencies pegged to traditional assets, are gaining traction in international transactions, potentially entrenching the dollar's supremacy in the digital age. By 2022, the dollar's share of global reserves had declined, while other currencies and gold reserves gained traction. The evolving global financial landscape presents both challenges and opportunities for the US dollar and the global economy. Thank you for watching. If you enjoyed the video, please like and subscribe. You can watch another video of our channel which is now on the screen.